Ladies and gentlemen, good day and welcome to the Q3 FY24 earnings conference call of Godrej Properties Limited. As a reminder, all participant lines will be in the listen-only mode, and anyone who wishes to ask a question may enter star and one on their touchtone phone. To remove yourself from the queue, please enter star and two. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kshitij Jain of Godrej Properties. Thank you, and over to you, Mr. Jain.
Hi, thank you. Good afternoon, everyone, and thank you for joining us on Godrej Properties Q3 FY24 with the results conference call. We have with us Mr. Pirojsha Godrej, Executive Chairperson, Mr. Gaurav Pandey, Managing Director and CEO, and Mr. Rajendra Khetawat, CFO of the company. Before we begin this call, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation. I would now like to invite Mr. Godrej to make his opening remarks.
Good afternoon, everyone. Thank you for joining us today. I'll begin by discussing the highlights of the quarter, and we then look forward to taking your questions and suggestions. The demand for homes in India is at its highest levels historically and has gained further momentum during the quarter. The positive market opportunity is driven by the overall strength in India's economy, the cyclical upturn in India's residential real estate market, the need for modern homes with better amenities, as well as consumers' preference towards Tier 1 developers. The RBI's upward revision of financial year 24 GDP growth outlook to 7% during the quarter reiterates India's position as the world's fastest growing major economy. The government's continued focus on housing for all and urban infrastructure, combined with the fiscal prudence evident in last week's union budget, strengthen our conviction that the real estate sector will continue to do well in the years ahead. The third quarter was Godrej Properties' most successful quarter ever in terms of new bookings, with year-on-year growth of 76% to rupees 5,720 crore. This was 14% higher than our previous best-ever quarter in quarter two of the current financial year. These consecutive record-breaking quarters have ensured that our 9-month financial year 24 sales have already crossed the booking value registered in all of financial year 23, which was our previous best-ever year. We are confident of building on this momentum and going well past our annual bookings guidance of 14,000 crore for the full financial year. This strong growth can be attributed to an extremely strong response by customers to some of our new launches during the quarter. Godrej Aristocrat in Sector 49 in Gurugram was GPL's most successful ever launch, achieving a booking value of over rupees 2,667 crore from 1.35 billion square feet of area sold. It is noteworthy that the total expected booking value for this project has increased by approximately 30% from the time we acquired it a year ago. Godrej Ananda in Bengaluru was another project which achieved more than rupees 500 crore booking value during the quarter. Godrej Avenue 11 in the Mumbai metropolitan region was launched in September 2023 and has achieved a booking value of rupees 687 crore within 4 months of launch. We are pleased to see this strong customer response to new launches across all the cities we are present in. Cash collections and net operating cash flow respectively grew by 43% to rupees 2,411 crore and 45% to rupees 798 crore in the third quarter. For the 9 months of the financial year, we recorded cash collections of rupees 6,743 crore and net operating cash flow of rupees 1,726 crore, representing a growth of 30% and 34% respectively. We remain on track to achieve our guidance of 10,000 crore of cash collections during the financial year. From a business development perspective, we added 1 group housing project in Bangalore with an estimated booking value of rupees 1,250 crore. We now have our strongest ever project pipeline that can deliver robust growth for the next few years. The most important objective for the company in 2024 will be to launch all of our recently added projects. We believe this will dramatically accelerate our bookings and earnings growth trajectory in the years ahead. We will, of course, continue to do targeted business development to plug holes in our current portfolio and ensure continued growth beyond the next 3 years. Our reported earnings for the third quarter were healthy, though somewhat muted, because we did not have any project completions during the quarter. Our total income increased by 43% to rupees 524 crore, and net profit increased by 6% to rupees 62 crore. For the 9 months of the financial year 24, total income is increased by 126% to rupees 2,410 crore. EBITDA is increased by 51% to rupees 548 crore, and net profit increased by 60% to rupees 254 crore. On that note, I conclude my remarks. Thank you all for joining us on the call. We'd now be happy to discuss any questions, comments, or suggestions you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Puneet Gulati from HSBC. Please go ahead.
Thank you so much, and congratulations on good pre-sales. My first question is on NCR market, which has become a substantial part of your sales bookings number as well. The market pricing also has been quite strong. What are your thoughts on NCR market? Do you think this kind of run rate of almost 2,000-3,000 crore that you're doing from on a quarterly basis from NCR will be sustainable? And how do you expect the market to absorb such high price inventory going forward?
Thanks for the question. I think the NCR market, has performed very strongly. We've typically noticed NCR, I think, in all directions of the market cycle seems to be leading the way. I think last time the down cycle there was first and quite sharp. We're seeing the up cycle also being first and quite sharp. Certainly our portfolio in NCR, we think, will support strong growth over the next few quarters. We've launched, and I think the reason for the very positive momentum we've seen in the past 2 quarters in NCR is we've had a big launch each quarter, one in Noida, one in Gurgaon. We last year added 5 projects in Gurgaon, of which only 1 has so far been launched. So we hope to have 1 project launch in Gurgaon each quarter of this calendar year, including the current one. We also have a second part of the Noida project that we'd added last year to launch again, which we hope to launch this quarter. While unfortunately it's been quite delayed, but we certainly hope to see Ashok Vihar launched in the first half of next financial year. And I think that will be another big boost to our scale in NCR. So certainly we do feel we have the project portfolio to maintain strong growth in NCR over the next couple of years, and are very happy with the kind of response we're seeing there. So we'll also be looking at new business development opportunities where those make sense. I think the level of price increase and sort of heatedness in the market in NCR is something we have our eye on. But my sense is while we won't see that trajectory continue, there has been a kind of reset in the market to these higher price points. Again, the down cycle in NCR was also quite severe, so the base from which prices are going up is reasonably low. So our best sense is that you won't see the kind of price increases we've seen over the last year that are very sharp on an ongoing basis, but probably more flattish to kind of moderate price growth going forward. But we see as of now no concern signs on the demand being overly driven by investors and end users not being interested and so forth. So I think we remain quite confident on the performance of that market. So certainly we'll keep a close watch on how it continues to perform.
Understood. That's helpful. Secondly, on your cash flow perspective, when do you think with the firm reach a situation where operating cash flows will actually start exceeding the business development related expenses? Or do you think that is something that one should not be aspiring for?
Look, I think we're already at that stage. I think this year we could be in a state where if we do business development at levels that is sufficient to kind of replace what we're selling, operating cash flows will, I think, more than cover those requirements. I think we have intentionally, over the last few years, done a one-time reset, given the opportunity we saw, particularly a few years ago when the cycle had still not taken off in earnest, where land prices were still quite attractive. We saw an opportunity to completely reset the scale of the business. We delivered pre-sales growth of 50% last year. We think that's possible again this year. So, clearly that will require disproportionate investment and more than the cash flows of a smaller base can pay for. But I think as the cash flows from our current sales start coming in, which we think has already started, of course, but will gather considerable pace through this year, we do expect to be in that position.
Okay. So when should we see it exceeding the land approval related cash flows outflows? Or this year, FY25? When should we expect the net operating cash flows exceeding the land related and approval related outflows? The 583 crore numbers this quarter versus the 1250 of approval. Should we expect that next year or the year after?
Yeah, again, I think, it is a function of how much business development is done. I think if you look at the booking value that we achieve in a year, if we only do business development roughly equal to that, I think we will already deliver this what you asked in 2024. If we choose for any reason to do more business development, that could of course change. And what could get us to more business development is if sales momentum is even stronger than we'd anticipated, and therefore the requirement to replace inventory is larger than initially anticipated. But I think we're quite confident that cash flows over even the next 12 months will be extremely robust.
That's very helpful. And lastly, if you can comment on the competitive intensity in the business development processes across various markets.
Thanks for the question. Essentially, if you see in the business development side, most of the leading players are in a stage of similar, which is basically launching their project. In some geographies, of course, there is renewed interest because, some of our peers are doing well. But I don't see as much of a competitive landscape on the BD side like we would probably say a year and a half back.
Okay. Okay, that's helpful. Thank you so much.
Thank you.
Thanks, Sunil.
Thank you. Our next question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, thank you for the opportunity. So just continuing on the NCR question, the first question which previous participant asked. So we have, roughly 2-3 more projects now. I mean, in fact, 3-4 more projects now in NCR, including Ashok Vihar. So, pretty much sorted for next year's growth. Now, considering that NCR is contributing 50% to our overall pre-sales in first 9 months, how do you see the visibility of, project additions in these markets? Because, whatever you acquired in last, couple of years, few of the land were acquired through auctions. So, how is the visibility right now? Is there enough opportunity to keep acquiring projects, to fill that gap which will happen over the next 1.5 years?
Thanks for the question. If you see, I think the question is more about replenishment of inventory in NCR specifically. We have done about 5 acquisitions in Gurgaon, and we had done 2 acquisitions through auction in Noida. Out of these 7, 2 have already got launched and very successfully. And we have, just by looking at the pipeline, next 4 to 5 quarters, every quarter, you would see a launch or 2 in NCR. And some of these launches have significant inventory, logged in. Like there is a project which should get launched hopefully in this quarter, which is quite sizable, probably one of the most sizable projects we've done in Gurgaon in the recent times. So one is that, is there a dire need to replenish inventory right away? I don't see that. But is there an opportunity to evaluate things at the right valuation? Of course, yes. So that is one. Second is, I feel that looking at how the government is shaping up, we would continue to see auctions coming up in NCR in the next couple of quarters, and we would of course evaluate them on valuation. If we see that the valuation is very attractive and we see opportunistic investment leading to more value creation for us, we'll of course participate. But it is not driven anymore by a necessity. It's more about can we take the opportunity higher.
Yeah, sure. That's helpful. And, just on your pre-sales guidance now, obviously it seems like, you would breach your full year guidance, and with launches coming up, what is the kind of expectations now you're building in for this year?
While we've not really given a specific guidance, but, largely if you see the previous 2 quarters, we've been, kind of have achieved a run rate of 5,000 plus crores. Is something directionally we would want to maintain that in Q4. But frankly, this could be better or something around that. So not giving a specific number, but this is something we would logically be delivering, something in that range.
Sure. And lastly, in Bangalore, which is a market where, you are targeting, few more acquisitions and try to fill that gap. So any outlook there, are opportunities coming in line, to your expectations, and, so any update on that?
If you see South Zone internally, as we label it, is one of a very interesting high performing markets from an inventory sales point of view. FY22 it was 700 crores, it became 2,200 previous financial year, and it is about to reach a similar number, in this financial year, and will significantly beat that of last year. So yes, you are right. There is a very targeted investment strategy for South. We've just done one acquisition in Yashwantpur, and the endeavor is that in coming months you would see a couple of other acquisitions in South India.
Sure, that's helpful. That's it from my side. All the best.
Thank you. Our next question is from the line of Praveen Chaudhary from Morgan Stanley. Please go ahead.
Thank you. Thank you for taking my question. I have 2 questions. The first one is the pre-sales, which I must congratulate. These numbers are very, very good and exceptional. So you mentioned last 2 years you've been growing at 50%. This year should also grow 50 to 60%. I don't think market is growing at that level. So I just wanted to understand the sustainability of pre-sales growth even in FY25 and 26, considering market continues to be strong. How should I think about it? Is a 20% annualized number a reasonable number, and then you eventually do 50, 60%? And what drives you to continue to beat the market or your peers is the first question. And the second question is related to the gearing, and you have 70% gearing right now, net gearing. And I just wanted to understand if there is a number that makes you comfortable, or for a short period of time you can handle even higher because that cash flow will eventually come back. Thank you.
Thanks very much. On the growth, I think obviously we're very happy to see 2 years back to back looks like roughly 50% growth. I clearly don't think those kind of growth rates will be sustainable over the medium term. And I think we'd look more towards, ambitious but reasonable steady state growth in the range of around 20% on an ongoing basis. But I think the opportunity we saw was to kind of reset the scale of the business during the downturn by raising capital, using that to invest when the timing was right. We felt in acquiring land, and we did a lot of outright land acquisitions with that same logic in mind, that we are acquiring at the right time, and it would be best to maximize our economic interest in the projects that are going to get developed through a rising market. And I think that's playing out as we'd expected. We certainly will continue to aspire for rapid growth. It could be some years, like we've had the last couple of years, but probably over a medium term perspective, roughly 20% is a sensible assumption, and one we can hopefully create some positive surprises on. From a gearing perspective, we've indicated that we'd like to maintain a range of 0.5:1 to 1:1. I think we think that is the range where we are best capitalizing on the scale of opportunity available in the real estate market in India today, while also managing our balance sheet prudently. That said, as you rightly pointed out, this is not a hard and fast gate where we can't go above or below this. We have, spent the last couple of years under this level as we raised equity with the intent of disproportionate investment. As that investment has happened, we've now entered the range that we'd like to operate in. I think what I would say is that if we were getting towards the higher end of that range, we would look quite carefully at what we need to do to further strengthen operating cash flows, to make sure that we don't go too far past that. But certainly, if we see very strong cash flows around the corner and feel that there are also good business development opportunities that we should seize, we would be okay with temporarily going beyond that range as well.
That's very, very clear. Thank you so much. If I could follow up with one more question, if that permits. The one question is about ASP expectation. Clearly, market is hot. Things are doing very well. But the concern is if the price go up too much too fast, then either we will get the speculators in the market or basically affordability will take a hit. What are you seeing in the market at this point in time? And are you worried that if this continues, maybe it will become less affordable in future? Thank you. That's all I have.
Yeah, look, I think, the real estate sector in India and globally has been prone to kind of a cyclical nature. And honestly, I'm not convinced that there's anything that any individual developer can do to change the nature of that cyclicality. And the reason for the cyclicality is also quite clear. It takes, from a supply perspective, quite a lot of time to respond to what one is seeing in the market. Therefore, in a bad market, developers stop bringing supply, and once the demand picks up, you inevitably get into a situation where supply is a bit short because developers haven't been actively planning for new developments during the down cycle. That in turn leads to the kind of price increases we're now seeing. Developers respond to that and, supply increases, and you then have the next leg of the cycle. So my sense is that, as an individual developer, the sensible thing to do is to try to understand to the best of our abilities where we are in the cycle, what is the most likely outcome. Understand that there cannot be certainty on this. We have to be prepared for all eventualities. Make sure that our balance sheet is strong enough to withstand the downturns and in fact take advantage of them, and that we have the portfolio scale to fully maximize the opportunity in the upturn. So I think, if you look at even the largest developers in India, including us and our other leading peers, would still have low to mid-single digit market share. So I think the ability to kind of determine pricing for the market is not as strong as one might imagine, and it is a little bit of responding to what we see in the market. And clearly, I think some markets are seeing very sharp growth rates, again, which is nothing that comes as a great surprise to us. This is very typical of the third year of the upcycle that we're currently in. I think we should also be quite clear that, 4 or 5 years from now, if history is a good guide, we should expect to see the cycle turn again. Now, again, that can move up or down by a year or two for various factors. But the basic cyclicality of the sector, I think, is here to stay. And I think it's incumbent upon individual developers to figure out how to best maximize the opportunities in each leg of the cycle and maintain a balance sheet that can withstand any surprises that come along.
Thank you very much, and congratulations for very strong results, operating cash flow, collection-wise, etc. So good luck. Thank you.
Thank you.
Thank you. Our next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi, good evening. So my first question is on our business development target. We have retained a full year target of 15,000 crores worth of GDV. Does that mean that, in Q4 we would see some high spend towards the land acquisitions?
Yeah, I think we will meet that target. I think we've already done about 8,000 odd crores or 6,000 crore of further booking value to be locked in. I don't anticipate a huge spend being linked to that, but yes, I think we will be doing some amount of business development this quarter. I think it's also worthwhile to note that we have a large, when you look at our deliveries guidance, there's also a large amount of deliveries planned during the quarter. Typically, there's quite a bit of cash flow linked to those deliveries, so this should also be a very strong quarter for operating cash flow generation.
Sure. And just a related question on that is, like, you know, if you look at this year, you'll if you increase your sales velocity by 50%, you'd be obviously selling more than what you'd be acquiring in terms of value, right? So in that sense, you know, how should one look at the business development goals, FY25 and beyond? Would it be significantly higher than our FY24 guidance that we have been giving?
I think, Kunal, probably appropriate to come back to on that next quarter as we see how the year ends, both from a total sales perspective, what amount of business development is locked in. But I think the overall philosophy of the company has never been around land banking or trying to create, multi-year supply beyond which we see immediate launch visibility, and nothing about that has changed. Of course, at the same time, we don't want to be in a situation where lack of inventory slows down our growth. So I think getting that balance right is something we'll fine-tune on an ongoing basis. And I think we'll be in a better position to share thinking for next year once we see kind of end of year, both business development additions as well as total sales for the year, which will give us a good indication. But I would say that certainly for the next couple of years, the portfolio is looking very strong. We do think that even without new business development, this year, next year, and to some extent even the year beyond that is looking pretty strong from a bookings perspective. So we don't think there's an immediate urgency, but certainly as the market is responding so positively to new project launches, we will have to think about replacing inventory perhaps a little bit more aggressively than we would have been 6 months ago. But we're also seeing quite a lot of opportunity on the BD side. So I feel that, as and when we decide to increase the pace, the opportunities we do feel are available.
Sure. Just a follow-up bookkeeping question on BD. How much did we spend on land acquisition, pertaining to this 8,400 crores of GDV that we acquired?
Sorry, come again, Kunal?
How much we spent towards land acquisition, especially for this 8,400 crores of GDV that we have acquired?
So for 9 months, we have spent around 4,300 crores of total outflow, which includes the approval and payment part. The exact land payment and approval payment plan I can give you offline.
Sure. Okay.
So this quarter, major payments for the 3 land acquisitions, 2 auctions we won in Gurgaon and a land parcel in Bangalore.
Yeah, fair enough. Okay, and my second question was a follow-up on the earlier question on debt levels rising. We have seen in the past few years, whenever we have reached, especially with the last 2 fundraisers that we have seen, when we have, reached closer to 0.8, 0.9 times debt to equity, we have raised equity. Would that be something that you would pursue this time around as well?
That's not the current thinking, Kunal. Again, I think the significant difference is also in the project scale-up that has happened this time, and launch scale-up. So I think the operating cash flows, we hope to show very, very strong growth over the next year. Look, I think, markets are very strong. We never rule out that idea either. But as of now, the thinking is that we can deliver already through the portfolio we've acquired strong growth for the next couple of years, and that operating cash flows we are generating will allow us to sustain that growth on an ongoing basis. I think the cash flow momentum you should see, I think will be quite positive. And again, the way the sector works is first the business development comes, then the bookings, then the cash flows, then the profits. I think we've clearly done already the business development. I think the bookings is now hopefully very visible. I think cash flow is also starting to become quite visible with, we've been growing cash flows each year by 40% plus for the last 2-3 years. We expect another good growth here this year and an extremely strong growth here next financial year. So I think, broadly speaking, that hypothesis is still very much on track.
All right. Yeah. Thanks. And my last question is to Rajendra. Rajendra, when we look at what will be our unrecognized revenue on our books?
Hardly, because, nowadays we recognize on OC, so most of the, revenue gets recognized. Only, 10-15% of the work completion, which is, towards the possession, what is left out is to be recognized. Otherwise, most of the projects where OCs are received are recognized.
So what I'm trying to reconcile is essentially we have done like almost 40,000 crores of sales in the last 4 years, and we have recognized about 6,500 crores of revenues in the last 4 years again. I understand a lot of our revenue sales also happened in LLPs, but still trying to understand or rather reconcile like what could be the unrecognized revenue, which should be a substantial number, but I'm just trying to reconcile that with the balance sheet where I see our current or non-current financial liabilities, which will be essentially customer advances.
Why don't we take it offline, and we can do a reconciliation, because it will require going project by project, year by year. And like you as rightly said, there are projects which are both into JV as well as outright. So we have to see, which got recognized into last, this year or last couple of years, and accordingly we will have to work out the revenue recognition.
Sure, I'll take it offline.
And on the land payment, just to answer, for this, 8,000 crore, we have paid around 1,900 crores towards the acquisition of that 8,000 crores of GDV.
Sure. Thank you so much.
Thank you. Our next question is from the line of Abhinav Sinha from Jefferies India. Please go ahead.
Hi. So congratulations to the team for the strong performance that we have seen on sales. So my question first is on the launches that we have planned for fourth quarter. What are the key projects and how good is the visibility there?
Thanks, Abhinav. So Abhinav, subject to, of course, us getting all the approvals, we have a visibility of probable launches one in Gurgaon, this is in Sector 89. Then there is one project which is Sector 146, if you remember the tropical isle that we sold, plot next to that, we have one more land parcel there. There in western suburbs, Mumbai, we are again in the process of getting all the approvals. This will be a very interesting launch for the Mumbai portfolio in Kandivali. And then something in Bangalore we're looking at in Old Madras Road. So these are like high impact and launches which will create a bigger impact. Of course, we have backup plans and additive plans in case any approval falls short of, but we are gunning for at least these big ones. Then we have plotted opportunities here and there. I'm just talking about the bigger ones.
Okay. And similarly on deliveries also, if you can help us with what we are expecting in 6.5 million or 6 odd million we are planning.
So we have a series of OCs planned in cities like, we can give you the list offline, but largely we have a couple of OCs planned in Gurgaon, Mumbai. Project names we will share with you offline. But yeah, we have a decent pipeline to get us a 12.5 million square feet of committed or guided OC calendar. Just to enumerate that, I think we also have in our, this is already part of the earnings, but projects like Mamudi, Mahalunge in Pune, projects like Meridian, parts of Godrej here, aspirationally also Kurukshetra project. So we have a series of projects which we are gunning for. Of course, some will come, some may slip to next quarter, but 12.5 million square feet of guidance that we have given, we are reasonably confident to deliver and exceed that.
Okay. And you were talking about earlier that the sales value today is much higher, 20-30% than what we had underwritten. So with that, what are the margins we are looking at now in some of these projects? For example, the Kandivali one or the Gurgaon Aristocrat, etc., that we have launched this year.
Yeah, not being specific project, but fair to say that the PAT margin is in a major expansion across most of our projects we've launched in places like Gurgaon, Noida. The western suburb project yet to hit, but historically, let's say if our PAT margin was say about 10%, fair to say, like to like, it will be a 15%, 16%, 18% kind of PAT margin. But of course, it will depend upon how the cost inflation is managed. So with some contingencies, it is a range at which our PAT margins. Of course, there will be some projects will be even higher than that, and there will be some projects within the range that I've mentioned.
Okay. And one quick question on NCR. So in Noida, we have seen some resolution, right, of these stuck projects which was being done by a committee there. So, and some of your projects have not seen a new launch for a long time. So, I mean, do we see those moving now, or that's another issue?
I mean, there is some, regulatory-led, resolutions which is impacting the entire market. It seems to be that it's in the final legs of conclusion, and that will open up a supply for us and some good quality developers, which is pending. But that being said, we do have some amount of sales. Yes, we've not been able to do a big bang new project launch, but sustenance figures any which ways are hitting in some of those projects. But yes, there is a big opportunity once the government is able to conclude those, give those kind of approvals to all developers. I think we will also have that upside.
Thank you, and all the best to the team.
Thank you.
Thank you. Our next question is from the line of Parvez Qazi from Nuvama Group. Please go ahead.
Hi, good afternoon, and congratulations for a great set of numbers. So I just have one question. For all the land deals that we have entered, what is the pending land capex which we need to incur over the next couple of years?
So the pending land payments, including the installment payment, would be around 1,100 to 1,200 crores. Plus there would be some FSI, TDR payment. So in all, around 1,300 to 1,400 crores is what we are looking at in quarter four. This includes payment towards pending installment of Ashok Vihar also, which is around 600 crores.
Sure. Thanks and all the best.
Thank you.
Thank you. Our next question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Hi, Pirojsha. Congratulations on a decent quarter. So my first question is on the business development. So if you can give us some color on the premium real estate side, especially in South Bombay. So what kind of land opportunities are available for us? And if we are evaluating those either through joint developments, like in the past we have done with one partner, but what kind of opportunity do you think can play out over the next 12 months for us?
Yeah, thanks for that. I think there are good options available in South Mumbai. I think we're looking at a combination of joint ventures with other developers or landowners who have land. Quite a lot of activity happening on the redevelopment side, the society redevelopment. We feel the Godrej brand gives us a lot of advantage there in terms of the existing residents being comfortable moving out and coming back in. So that's going to be a big area of focus for us. There are also, some outright purchase opportunities that we might look at. So I think really the full spectrum of opportunities is available in South Mumbai. We hope to have some good project additions there over this next few quarters, where we already have seen good response to our first launch in South Mumbai after a while. Our project in Mahalakshmi, which is a project we took over, that has been, that has gotten into difficulties. That project is going very well. We sold about 700 crore worth of inventory there since it was launched 4 months ago. We hope to launch our project on Carmichael Road later this quarter. So hopefully we can see a good scale up in the South Mumbai market alongside our overall plans for BD elsewhere in the city.
Okay. And just on some of the key projects which have been lagging behind in terms of launches. So one was Ashok Vihar, which you said you will launch in first half of next year. What about the Worli project? And if you can give us any update on your Bandra project with your partner Omkar, any movement there, if you can help us with some color on this.
Yes, actually it's been very positive movement on some of these Mumbai projects. I think, our learning from this is perhaps that we were a little over optimistic on timelines on some of these slum redevelopment type of projects, which both Worli and Bandra project are. A lot of tenant movement has happened actually in the last quarter in Worli, so we're increasingly confident of that project being ready to launch in the upcoming financial year. I think Bandra also, there's been quite a lot of movement on the side in terms of understanding the current situation with the partner, and we're quite confident that we'll see a lot of momentum in that project during the upcoming financial year. But it's probably not a project that will actually get launched in FY25. But I'm feeling much better that that project will eventually be launched than we were perhaps 6 months ago. So I think there's positive movement there. It is frustrating to see, that some of these bigger projects have seen delays, including Ashok Vihar. We're obviously doing our best to ensure that those are mitigated. I'm quite happy with the work the team has done to ensure that despite some of these plans getting affected, it hasn't impacted the overall growth of the company. Both last year and this year, gunning for 50% kind of growth in pre-sales, and I'm quite happy to see that might be achieved even without these key projects. Overall, something like Ashok Vihar, while very frustrating, if we are able to launch it over the next few months, as we hope, the delay will actually have benefited given the kind of momentum we've seen in NCR on volumes and pricing. And I think what's great to see is some of these projects we perhaps didn't think of as very critical projects in the overall scheme of things, something like our project in Noida or this recent launch in Gurgaon are actually becoming very meaningful projects for us. If you look at the total scale of the Noida project, which we acquired at auction for about 300 crore, we've already sold more than 2,000 crore of inventory in just the first phase of that project. There's an equal size second phase that we launched this quarter. So, we hope to, over the project lifetime, get to 4,000 crore plus of booking value in that project, which, as you can imagine, with a 300 crore odd land cost, should create very healthy margins for the company once that project is delivered. Similarly, if you look at these Gurgaon projects, we've already sold 2,600 crore. The pricing premium, that was initially about the expectation we had for the overall booking value of the project. We still have more than 20% of the inventory in that project. So I think, all of these projects are going to become quite meaningful from a bottom line perspective. But we certainly look forward to launching some of the bigger ones like Ashok Vihar in particular, but also Worli and Bandra. Incidentally, our Godrej project is we hope going to launch this quarter, and that project is actually by total expected booking value significantly larger actually than Worli or Bandra. So we're looking forward to kicking that one off this quarter.
Sorry, which project you said? Pirocha or EMS? The last project you said.
There's a project in Kandivali which was about...
Yeah. Okay, Kandivali. I got it. Just last one on the Vikhroli. So you mentioned on the on-track launch of 0.6, but I think Gaurav did not mention that in the high probable launches for this quarter.
So we are planning to launch that. I think frankly, from a total scale of launch, it's perhaps not quite as big as the Kandivali one or some of these other ones in terms of what we expect booking value during the quarter, but we certainly do hope to launch that and looking forward to Vikhroli getting going again.
Okay. Thank you, Pirocha, and wish you the best.
Outright plan on projects and the DMC top of mind for him. Okay. Thank you, Pirocha.
Thank you. Next question is from the line of Ishit Sheth from Anvil Wealth Management. Please go ahead.
Hi. Thank you so much for taking my question, and congrats to the entire team for very good results. So for Pirocha, a couple of questions here that I have. If we look at the strategy that you led the team on, to actually lever up the balance sheet just at the start of an upcycle in the real estate market, I think that is showing significant fruits for our company. Now, what I wanted to understand was that if we look at the last 2 years, you've always been consistent in saying that our objective is to grow 20% over the medium term when we look at Godrej Properties. Now, if you look at the first 9 months performance, there has been a stark difference between the sales volume growth and the sales realization growth. A large part of it is because of the way prices have moved up in a lot of geographies, including the NCR. So when we talk about this 20%, because pricing is something which is not in our hands, So when we talk about 20%, is it a large part to do with volume growth that we're looking at when we talk about this 20% growth over the medium term?
A couple of things to point out. One is, I think our volume growth year to date is about 20%. Our volume growth last year was 40%. And another thing I just point out is that the pricing growth you referenced is not actually just market pricing growth. It is a complete repivoting of our types of projects to more premium projects. So if you look at it, yes, there has also been market price-led growth, but a lot of the pricing growth that you're seeing for GPL is actually more premium set of projects coming into our launch pipeline. So, our project in Gurgaon, for example, we sold at almost 20,000 rupees a square foot. Now, of course, that is much higher than we had underwritten the project at, but this is also, even the underwriting was much higher than any previous project in Gurgaon, because it's our first project in Golf Course Road. There are similar examples across various cities. So certainly we will be focused on volume growth being strong, but I think there is also a pricing growth opportunity, not just provided by the market, but by us becoming focused on more premium areas. I think in general, this year is probably a good base for that. We don't want to become an exclusively luxury developer by any means. So we want to have a right mix of premium projects and mid-income projects, and that will continue. But I think if you look at this year's kind of project mix, we think it's where we would like to play on an ongoing basis, and therefore, going forward, most of the growth in top line should happen from a combination of volume growth and market pricing growth. But I think if you look at GPL's growth in the last 3 years, it's both some amount of market pricing growth, but largely volume growth and more premium projects driving that growth so far.
Sure. So then the second question is that, it's just so happened that in the last 2 years, at the start of the year, we've budgeted or we've guided for some amount of sales as well as, deliveries. And it just happens that, we've exceeded every year substantially. Now, is the team prepared for this kind of execution? Because, if you look at the past, we've not executed at this scale. So are we very well prepared in terms of the execution part of it?
I think it's a great question, and certainly I think something, the team obviously spends most of its time on. It is going to be a challenge to scale up execution, but one that we've certainly done everything we can to prepare for, whether you look at the structure of the company in terms of how we've set up individual projects and our zonal teams, if you look at the kind of relationships we're trying to build with contractors and elsewhere. So certainly I think the good work the team has been doing should allow us to do this very effectively. And I think it's also true that, Godrej Properties every few years has scaled up very differently from kind of what it looked like 3 or 4 years before that. So I think now with even more rapid scale up, we will be very focused on ensuring our operational capabilities are matching that. And as you said, also, I think one advantage of focusing a lot on outright owned projects as well as more premium projects is that the scale of operational intensity has not increased quite as much as the overall sales value has.
I couldn't agree more with what Pirojsha just mentioned. And, I think the essence, if you study why Godrej Properties is probably poised best to perform in the subcycle, is we're the only company which has something like a branch-led operating model, which is like every site is a P&L for us. So we have a very decentralized ecosystem. Of course, governance and controls coming from central, but every site is an operating unit to us with an operating team with very well-defined targets, being measured weekly and monthly on set of KPIs. So yes, the execution muscle, the governance muscle always has existed for us, but just having the right operating model is allowing us to capitalize in the opportunity of scale up. And while this looks to be a very strong growth and very delighted to see that, But if you just see from our lens, we have 4 business units. Each business unit is run by a sort of a CEO with an executive leadership team. So the problem of execution excellence comes when the scale of action is frankly much more higher, like some of our peers who operate in 1 or 2 geographies. So I think the potential for us to do better and ensure that each KPI is delivered upon is very low hanging for us right now. But of course, this is something which we don't take for granted, and we keep a very strong tap and performing strong monitoring mechanisms to ensure this. Yeah.
Got it. Sir, and just one last question I had. At the end of this quarter, we saw the resignation from your uncle, Mr. Jamshed Godrej. Is there any kind of precursor to some kind of a settlement for the Vikhroli land that we can look at for Godrej Properties in specific?
No, I think we announced the rationale for the resignation along with the announcement, which is that we have a board policy of our directors stepping off the board when they turn 75. My uncle, Godrej Godrej, turned 75 about a week or 2 ago, and therefore at that time stepped off the board. We're very grateful to all his contributions to the company over that time. And he's, I think, the third director in the past 12 months who would have turned 75 and stepped off the board. So that's the rationale.
Okay. Got it. Okay. Thank you so much, sir. Thank you for taking the questions.
Thank you.
Thank you.
Our next question is from the line of Janvi Shah from LIC Mutual Fund. Please go ahead.
Hi, good evening. Hello.
Yeah, go ahead, please.
Yeah. My question was, can you give us some updates about the Godrej Property in Gurgaon on how, what are the repair works going on, and what is the number of the customers that took up the offer of buyback?
Yeah, the repair works there are on in full swing. We hope to complete them by the end of this calendar year. As of now, we've had about 10% of the customers opt for the buyback option. So we've bought back a little over 100 apartments so far. We expect to see that go to about 200 over the next few months basis current visibility.
And out of the 155 crores that were provided for rent, how much did it cost?
We have spent around 20-25 crores till date.
Till date. Okay. Thank you. Thank you so much.
Thank you. The next question is from the line of Ritvik Sheth from One Up Fin. Please go ahead.
Hi, good evening, and congratulations on a great set of numbers, sir. So I have just one bookkeeping question. The cash flow statement that we put out in the presentation, is the net operating cash flow to our share, or this is before any share to JV JDA?
Yeah, our share.
It is our share. Okay.
Yes.
Okay. Thank you and all the best.
Thank you. Our next question is from the line of Manoj from Geometric. Please go ahead.
Am I audible?
Yes, go ahead, please.
Okay. Congratulations, Pirojsha, for a great set of retail number and the kind of profitability it gives, like you said, 18%+ something plus. My one is a bookkeeping question. What would be our corporate fixed cost for FY23 and what would be for FY24? Any range, ballpark, any number?
So corporate fixed cost is generally after allocation would be in the range of 3 to 4%, but on an overall basis, it will be at a pan-India basis, it will be like a 6 to 7%.
Okay, 6 to 7%. Okay. And my second question is, like people are asking about debt equity gearing. So the kind of cash flows the company is because of this pre-sales and the kind of profitability with this thing. And even if it being a different accounting method, the equity would have changed. How do you think about your BD development with these kind of misrepresented debt equity? Any ballpark absolute number of debt do you have in your mind? How do you think about it? How do you want to communicate to the shareholders?
Yeah, I think we've mentioned the gearing ratio that of anywhere from 0.5:1 to 1:1 is broadly our comfort level. 1:1 would be a little under 10,000 crore at the moment. So that's roughly the number we look at. But we've also said that, temporarily, if we need to be below or over that, as long as we're confident of bringing it back into that range, we would be comfortable to do so in the short term.
Okay. And my last question is, can you tell something more about our project Ashok Vihar? What would be the size and what would be the kind of offering it would have, if it's possible?
No, I think, of course, we'll have all the information on it once the project is ready for launch, but it's going to be a large project for us, nearly 4 million square feet of area. I think pricing in NCR has done very well over the last few years, so we're very confident of that project achieving a good price. I think given the location of the land, the surrounding area, the quality of the plan we have, we hope to make that a blockbuster launch as soon as our approvals are in place.
Okay, and thank you and best of luck.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for closing comments.
I hope we've been able to answer all your questions. If you have any further questions or would like any additional information, we'd be happy to be of assistance. On behalf of the management, thank you once again for taking the time to join us today.
Thank you. Ladies and gentlemen, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.